I'm Ron DeLegge. You're watching ETF Guide TV, and it's great to have you with us. I want to share some charts with you. I promise not to take a lot of your time. I know we've reached the halfway point of 2023, and I also know that you want to get to your vacations and your relaxed time. And guess what? I want to do the same. I need some relaxed time. Let's take a look at the charts, and without further ado, and this is the CNN Fear and Greed Index, which basically gives us a temperature of the market's mood. And right now, as you can see, we're in extremely greedy territory. Now, this is just for the equity markets. This is not cryptocurrencies or bond markets or anything else. And a year ago, we were at exact opposite. You can see we are at fearful levels. And of course, a lot of this has to do with just the behavior of markets, which are reflective of the public's mood. It was Gerald Loeb who once quipped that the single most important factor shaping stock prices is public psychology. And that's still true today. And we see that reflected here, that there's a lot of FOMO going on, fear of missing out. People are chasing performance. Equity markets have been in a good mood thus far in 2023. And if we take a look at this in terms of the actual performance of industry sectors within the S&P 500, these symbols, by the way, are the ETF tickers that track these specific sectors. And there's 11 industry groups within the S&P 500. If you slice it up like a Chicago pizza, deep dish, I'm from Chicago, so I do have a bias. But, you know, New York pizza is pretty good too. You can see here that the top three industry groups are technology, communication services, and consumer discretionary. And all three of these groups are up bigly. You can see anywhere from 32 to 40% in value. And if we also take a look at how much of these of the S&P 500 these three sectors represent, you're looking at almost 50%, or roughly 50% of the overall S&P 500. Its equity exposure is in these three sectors concentrated. So when you ask yourself, and I'm going to show you in this next chart why the S&P 500 is doing so well, what's driving it? Well, it's these three sectors: tech, communication services, and consumer discretionary. Let's take a look at the next chart. This looks at, before we do that, looks at the number of sectors up versus down. I should note that this particular number was reversed in May. So you can see that we have more bullish upside in sectors than down. So again, this just shows you the market's mood right now is happy, it's bullish, more sectors up than down. If you're a bull, that's great. In terms of the big three equity indexes here in the U.S., you've got the Nasdaq 100, the S&P 500, and the Dow Industrials. These are the ETFs tracking each of those equity benchmarks. The triple Qs, as you can see, are the runaway winners. They are just dominating in terms of performance. And if you want to see dominance in a chart, this is it. Triple Qs up almost 40% and leaving DIA and SPY in the dust. In terms of the single stock ETFs, this is a relatively new area of the ETF marketplace that I think is going to only get bigger as more investors discover its existence. And yes, it's higher risk, and yes, it's more concentrated, but it does, I think, have a place inside your non-core investment portfolio. And here's a couple of top performers thus far in 2023. These three ETFs track individual stocks. Which companies are we talking about? I think you know who I'm talking about. Nvidia, Tesla, and Apple. Now, these three ETFs do it with 150% daily leverage. That means if any of these stocks is up, let's say 1% on a given day, they're going to aim to be up 1.5%. So again, that's 150% gain. That's daily performance. It's not monthly. It's not yearly. So there's going to be a little bit of a variance when you span out the time frame. But you can see here NVDL, a delicious gain of almost 350%. TSLL, which is linked to Tesla, up 180%. And then the worst performer if we could even say worst, is Apple. Really not worse, but great, but less great, I should maybe say. And AAPU up just over 76%. So again, this is what the single stock ETFs are doing, delivering big returns. This is still a very new area of the ETF marketplace. I think it's going to get bigger as investors flood more money into these ETFs and take a look at amping up their exposure without having to incur margin debt. So that's that. Here's an interesting chart that was shared by our fellow ETF Battles member and prize judge, John Davey, over at Astoria Portfolio Advisors. This takes a look at the current bear market rally, and that's what this is. It's not a new bull market, as some have said, but if we take a look at the bear market rally since its bottom in October of 2022, we're now at 240 days, making it the longest bear market rally in history. And it's pretty amazing, this chart, when you compare the length of this particular bear market rally compared to all of the others before it. It's certainly long in the tooth. But as they say, who was it that said it? The market could stay irrational longer than you could stay liquid. I think that was an economist, Keynes, John Maynard Keynes, if I'm not mistaken. So some key takeaways. First of all, S&P 500 industry sectors are clearly more bullish than bearish. We've got 7 sectors positive, 4 that are negative. And you know what? The 4 that are negative, it's not really super bearish performance. They're marginally down or flat, and that's not exactly super bearish. So again, the momentum seems to be to the upside. One thing that is a little bit worrisome is the greediness. The market is very greedy on many levels, and you want to be careful of that. You always want to be, I think, thinking of doing the opposite of what the broader market is. If it's greedy, you want to be defensive. If it's defensive, you want to be greedy. And so these are just things that strategy-wise that I think you should be thinking about in terms of, positioning your portfolio and maybe lightening up and not taking as much risk. And then finally, you got those single stock ETFs continuing to be hot performers. As I said, if you're going to use them, the only place to use them, there's only one place within my 3 portfolio, well, it's 3 bucket portfolio framework. There's 3 buckets, 1 portfolio. You got your core, your non-core, and your margin of safety. The single stock ETFs with that framework only go in one place, and that would be your non-core portfolio. They don't belong in the core bucket, and they certainly don't belong in the margin of safety. And then, again, finally, now is a good time to deploy your portfolio's margin of safety. You want to do it when market conditions are friendly. And to help you do that, I've just launched a margin of safety tool. We've been working on this behind the scenes. Yay to me. Finally, we've done it. And this tool will help you to understand how much of your overall portfolio should be earmarked for safety. And it's going to do 3 things. Number 1, it's going to provide you with liquidity. It's going to provide you with peace of mind. And it's also going to provide you with principal protection. That's what it's all about. And that's what your margin of safety bucket should be doing. It should give you stability, not just in good markets, but bad markets, especially bad markets. And it's always important to think about the storm before it hits, not as it's hitting, and certainly not when you're in the midst of it. You want to just have some forethought and do some planning. So this tool will help you to do it. It will report your margin of safety 2 ways: as a percentage of your overall portfolio, or if you plug in your actual portfolio to the tool, it will report it in dollar terms. So you can see down to the penny how much of your overall portfolio should be earmarked for safety. So head over to etfguide.com. I've got a link below in the description section of this video, and you can certainly check out the margin of safety tool and let me know. And then after you've calculated your margin of safety, the next step is to implement it or deploy it, right? What good is just the calculation part of it if you're not going to ever implement it. And so that's what I want you to really understand. The other thing about the margin of safety tool is that it's not a one-time exercise. Once you calculate what your margin of safety is today, we recalculate this the following year. And then the year after that, we recalculate it again. So it's an ongoing process. It's not a one-time exercise because risk and financial markets are dynamic, right? So we need to be dynamic in order to address those risks. And so the way that you do that is by going through this exercise. Usually it's a once a year annual exercise to calculate how much of your portfolio should be in your margin of safety bucket. And also, I've got a link below in the description section that has an explanation, deeper, further research on the margin of safety strategy and how it works. I've got a whole playlist earmarked and dedicated to that, again, in the description section below. So that does it. It's time for relaxation, and I hope everyone has a safe and delightful holiday weekend. And we've got new episodes of ETF Battles and First Look ETF, as well as Portfolio Makeover and others coming for you. So stay tuned for that. Be sure to subscribe to ETF Guide TV. I'm Ron DeLegge. Thanks for watching, and we'll see you next time.